Our next presenter is Ian Purdy, Managing Director and CEO of Paladin Energy. Thanks so much, Ian. Over to you.
Good morning, everyone. Unfortunately, I can't be there in person today. I am very jealous, but hopefully next year I'll be able to join you in Noosa. Thank you very much for your time this morning. What I'd like to do is take you through the Paladin Energy story. I'll talk through some of the key elements of the company and then spend a little bit of time just talking about some recent exciting movements in the uranium market. So I'll just spend a little bit of time on the first slide and take you through some highlights. We're in a very strong position and we're very well placed within the uranium market, which is a very small market. We are a producer who have a very strong heritage of production. We are in care and maintenance at the moment, but we have a very clear pathway back to production.
Ian, your screen's not shared. Did you want to just try unsharing it and resharing it, please?
Sure. How's that, Amy?
That looks good.
Thank you for that.
That's okay.
We have a very strong production heritage with a 10-year track record of producing uranium production at our Heinrich mine in Namibia. It's a world-class mine which is strategically significant to the uranium market. It accounts for about 3% of global production when it's at full capacity. The mine was placed in care and maintenance in 2018 due to the sustained low uranium prices at that time. And we really were protecting the value of our resource with a view to bringing it back on stream as uranium prices improved again. We've got a very well-known product. We've sold to global utilities over 43 million pounds over those 10 years, and those pounds have gone all over the world. Really importantly for us, we're fully permitted and licensed, not only to resume mining and processing, but also to resume uranium exports from Namibia across the globe. That's really important for us because, as you would be fully aware, it's not a straightforward exercise to have a uranium mine licensed and environmentally cleared. We've completed a comprehensive mine restart plan, which we released in the middle of the year. And that restart plan shows a very clear pathway back to production for us and also highlighted a range of opportunities for us to maximize our plant reliability and runtime. Looking forward, we've got a long life operation with some 17 years life today going forward. And our strong economics are underpinned by all of our technical work that we've completed. We've done detailed mine planning and we've got a proven plant process flow. Our operation was very successful for the 10 years in which it ran. We're in a strong financial position. We have a very strong cash balance with over $32 million US in the bank. And we've done a lot of work in reducing our cash burn rate down to below $10 million per annum. And that includes our care and maintenance costs for our operation in Namibia, as well as all of our project work and our corporate costs. And where we are today, we stand ready to resume contracting with our historic and new potential customers in an improving global uranium market. I had the opportunity to travel to Namibia earlier in the year, just before the world shut down due to the travel restrictions. And for those of you who've been to Namibia, you'll share my views in saying it is a terrific jurisdiction to have a uranium mine. It's a globally significant uranium province with two other world-class operations in the same region that we are in, the Husab and Rossing mines that are owned by the two largest Chinese uranium agencies. And when we're all up and running at full capacity, we're some 12% of the world's uranium production. Uranium's been continually produced in our region since 1976 and is a large contributor to the country's GDP, very well entrenched within the local community. And I can say confidently, the local community and government are very keen to see our operation restart and rejoin part of that significant uranium hub. A little more detail about our production track record. We own 75% of our mine in Namibia. The other 25% is owned by the largest Chinese uranium agency, CNNC, a very good partner for us. And we also have our offtake for 25% of our production with CNNC. We produced first production in 2017. We peaked at 5.6 million pounds before we suspended the operation in 2018. We've maintained an extensive care and maintenance investment program since we put it in care and maintenance, and we've had it independently verified that our plant, mine, and associated infrastructure is in good standing and ready for a restart. We announced a detailed comprehensive plan to bring it back into production in June 2020. And given our historic operation performance, our historic relationship with global utilities, our mine plan, and our significant cash runway, we have the flexibility to respond to an improving uranium market. Looking at our product and our sales, we've delivered product to all of the global conversion facilities around the world. We've never missed a shipment or had a reject due to quality, and that puts us in very good standing when we talk to our prior customers and when we talk to our new customers. We're going to do more work on the facility to make it even more reliable than it was previously. And as I mentioned, we have a very good offtake with our Chinese partner, and we have delivered many, many pounds into that offtake over the years in which we were in operation. The focus for us now is to secure term offtake contracts with global utilities to underpin the restart and to underpin the economics of our restart program. Looking at some of the KPIs of our study work, we have a modest cost to restart our operation, $81 million. Over half of that is geared towards improvements, mechanical improvements to our process flow, which will give us more reliability than when we ran previously. And the other half is just general working capital. The infrastructure, the plant, and the mine development today would cost us about $600 million US if we were starting as a greenfields operation. So we're in a very fortunate position. Our C1 cost of production over the life of mine is US $27 a pound. That puts us firmly on the second quartile of the industry cost curve and puts us in a very competitive position. We'll peak at about 6 million pounds per annum for 7 years whilst we continue our mining of the open pit production with a total life of some 17 years. And our restart capital intensity is very, very competitive given our plant's already built at some $14 a pound. That compares with up to $100 a pound if we were a greenfields operation. Looking briefly at our production rate, you can see we have a very quick ramp up. We expect to be at 80% of nameplate within 6 months, and then within 100% of nameplate within 12 months. That's primarily because we are a brownfields operation. We're not changing our process flow in any material way, and we're going to be improving the mechanical availability. I'd now like to turn to the uranium market. It's a really interesting time for the uranium market. The uranium market is characterized by a structural supply deficit. The graph on the left-hand side is from the World Nuclear Association, the leading body in nuclear energy around the world. And what they're showing is that primary uranium supply is unable to meet current demand. The industry has been living off stockpiles. There's a projected deficit requiring the restart of idled production capacity like ourselves. And there's some further closures in 2021 with 2 more long-term uranium producers closing down, scheduled for the end of Q1 2021. Just some quick nuclear generation facts. Nuclear energy accounts for 10% of global electricity generation. It's held up incredibly well during the COVID disruption to global economies, being baseload generation. It's been critical in keeping the power running. 20% of the United States electricity comes from nuclear generation. It is the second largest source of global clean energy with almost zero carbon emissions. Only hydropower provides more clean energy to the world. There are some 440 odd reactors across the globe in 33 countries, and there's 52 reactors under construction in 19 countries. There is a lot of demand for nuclear energy, and it is very much a growing segment of the global energy framework. This chart really focuses on our customers and our customers' position in terms of forward contracts. The chart on the left-hand side, this shows the contract coverage of the global utilities in terms of their forward purchases of uranium. And you can see from the line sloping downwards that the global utilities do not have a lot of contract coverage on their forward purchase book for our product called yellowcake. It's reaching critical low levels in the US, and the US utilities in particular have not been in the long-term market for a fair period of time. There's been some regulatory uncertainty in the US market. One of the major elements was a piece of legislation called the Russian Suspension Agreement. That has now been clarified and finalised. That suspension agreement has been extended, which restricts the amount of secondary supply that can be brought into the US market. That provides regulatory certainty for our US customers regarding their future uranium supply requirements. If you look at the graph on the right-hand side, this shows the total contract activity, term contract activity, for the last 20 years. And what you can see is since 2012, the utilities have not been contracting to the level of their consumption. In fact, they've been well short of their consumption levels. Hence, they have large uncovered positions going forward. What we're seeing is a tightening of the spot market, and we expect that to reduce the volume of mid-term carry trades, which have really kept the utilities going over the last 5 years. When you look at this market dynamic, it's conducive to increased term market activity happening in 2021, which is really important for us because that term market activity is a catalyst for our restart and for underpinning our restart. Looking at the pricing in the uranium market over the last 10 years on this graph, it's been a bit of a roller coaster in uranium, and it has been a depressed market for an extended period of time. There's two markets in uranium. There's the term market, which is the important market, and that accounts for over 80% of the transactions and the volume in the market. This market is a bilateral negotiated market. We will be signing bilateral contracts with individual utilities, and they will be confidential between us. So that's 80% of the market, but there is a small spot market as well, which accounts for about 20% of the global market. The top line is the estimated term price, and the bottom line is the estimated spot market. And what's interesting is when you take a step back and you look at the trends, we've seen the spot market steadily increasing since 2017. It's come up by some 60% with quite a jump in the last 12 months as we've seen some pretty significant COVID disruptions to global uranium production. What we're also seeing is that term contract pricing and term contract activities are starting to get a little bit of momentum going again. And we're starting to see some activity back in the term market. And we note that TradeTech, one of the commentators of the uranium market, have quoted the current term price at about $37 a pound, up some 30% in the last couple of years. So again, really good signs for us. And I think what's really pleasing for all of us in the uranium space is the discipline being shown by the two largest producers in the world, Kazatomprom and Cameco, two companies that represent over 60% of global production, are being very, very disciplined. And they're not only restricting short-term supply, but they're restricting mid-term production levels as well in a very visible way to drive the pricing that we're seeing back to a more sustainable level. So what does all that mean for Paladin? Firstly, I want to emphasize again how important our strong operational track record is.
Move to your last slide, please.
Sorry.
Move to your last slide, please.
Sorry, my screen share. I'll just get my screen share up again. Is that showing now?
Perfect.
Okay, thank you. Our strong operational track record is very, very important in this industry. There's only a handful of producers in the world, and we are one of only a couple of producers who have ever produced production and are ready to restart. This is very important for our customers because they will be contracting with us 2 years ahead of deliveries. So they need the confidence to know that we will be there to deliver our product when they're ready for our product. We're very competitively compared to our other uranium projects. We're poised to take advantage of the uranium market, and we have a very strong position. So thank you very much for your time this morning.
Thank you so much.